Are you curious about potential ways to pay off debt faster and some of the pros and cons associated with these strategies? In this video, we'll be taking a deeper look into velocity banking, which is a financial strategy that can potentially help individuals pay off their mortgages or other types of debts faster and potentially save money on interest payments. We'll take a closer look into what velocity banking is, go over an in-depth example, and cover off the pros and cons of using this strategy. Whether you're familiar with velocity banking or just beginning to learn about the strategy, this video will provide you with a deeper understanding on the strategy and key things to always look out for. Before looking into the pros and cons of the strategy, it's important to first answer the question, what is velocity banking? Velocity banking is a financial strategy that involves using a line of credit to pay off debts faster. The basic idea behind velocity banking is that by using a line of credit, you can reduce the amount of interest you pay over time and accelerate your debt payoff. Let's take a look at an example of velocity banking using a homeowner's equity line of credit, also commonly known as a HELOC, to help us accelerate paying off an individual's mortgage. While going through this example, it's important to keep in mind that theoretically, the same principles can be applied to other types of debt, such as credit card debt. Let's imagine that Chris currently has a 30-year fixed-rate mortgage for $300,000 at an interest rate of 4%, and a HELOC for $50,000 at an interest rate of 5%. With the mortgage, the interest is calculated based on the outstanding balance of the loan each month. So in the first month, Chris would owe $300,000 in principal, and his interest charge would be calculated based on that amount. As he makes monthly payments, the amount of interest Chris owes would decrease because he's paying down the principal. On the other hand, with the HELOC, the interest is typically calculated based on the average daily balance of the loan over the course of a month. So Chris uses the HELOC to make an extra payment towards his mortgage principal. The balance of the HELOC decreases, which lowers the average daily balance and the amount of interest that he owes. For example, let's say with the HELOC, Chris makes an extra payment of $500 each month towards his mortgage principal. Well, you're probably wondering, what impact would this have for Chris opposed to just paying the extra $500 directly to his mortgage? Let's break it down. Chris's monthly mortgage payment without velocity banking would equal approximately $1,432. Now let's look at the same monthly payment, but this time let's include the $500 from the velocity banking strategy. Chris's monthly payment would then be equal to $1,932. At first glance, it might seem like all Chris is doing is increasing his monthly payment by using the HELOC. However, by paying down his mortgage principal faster, he can potentially end up saving a significant amount of money on interest charges due to the accelerated payments and the fact that the interest on the HELOC is calculated based on the average daily balance. Let's take a closer look at these interest savings. If Chris chooses not to accelerate his payment of his mortgage, over the total 30-year mortgage, he would pay a total of approximately $215,000 in interest. But if Chris implements the velocity banking strategy of adding an additional $500 HELOC payment, he'd reduce the total interest charges down to approximately $136,000, meaning over time, Chris would save approximately $79,000 on interest charges over the course of his mortgage. Plus, Chris would be able to pay off his mortgage in approximately 20 years rather than the initial 30 years. As you can see in this example, by using velocity banking, Chris is able to accelerate the payment of his mortgage while saving on interest charges. This means that even though Chris's monthly payment is higher, he can still come out ahead by paying down his mortgage faster and saving on interest charges through leveraging his HELOC. Although at a first glance, the strategy can seem like a no-brainer, it's essential to consider the potential drawbacks of velocity banking, as every individual has their own unique financial situation. Whenever making any financial decision, it is always best to consult with an expert about your own personal situation. Now that we have a better understanding of what velocity banking is and some of the potential benefits such as reduced interest payments and paying back your mortgage faster, let's take a closer look into some of the risks associated with the strategy. First off, if you're using a HELOC, as we talked about in the example with Chris, for velocity banking, it means that you're using your home as collateral. If you're unable to make payments on the HELOC, the lender can foreclose on your home. It's important to keep in mind the various circumstances that may put you in a situation where you're unable to make payments on your HELOC or other lines of credit. This is part of the reason why velocity banking also requires discipline to stick to a budget and consistently make extra payments towards your mortgage principal. If you're unable to stick to your plan, you will not see the full benefits of the strategy. As well, unlike a fixed rate interest plan, lines of credit like a HELOC are typically variable rates, meaning that they can fluctuate over time. If interest rates rise like we have seen all throughout 2023, your monthly payment on your line of credit could increase as well, which in turn will reduce the return you get from the strategy. In our example, with Chris, we mentioned that the HELOC interest was 5%, but if this were to shoot up to say 12%, the strategy would not have nearly the same effect. And finally, velocity banking may not be suitable for everyone. For example, if you're already on track to pay off your mortgage within a reasonable time frame, velocity banking may not be necessary or the right strategy. This is because there is an opportunity cost associated with paying off your mortgage faster. By putting extra money towards your mortgage, you may be missing out on other investment opportunities that could potentially earn higher returns. For example, if you have a low interest on your mortgage, it may make more sense to invest the extra money in things such as the stock market or a retirement account that has potential to earn higher returns in the long run. All in all, it's important to carefully consider all the risks and benefits associated with velocity banking before deciding if it's the right strategy for you. Since every individual has their own unique financial situation, the positive or negative impact of velocity banking will vary for every individual. If you found this video to be helpful, be sure to like and subscribe to stay up to date and informed on a wide variety of everyday financial and self-improvement topics. Thank you for watching, and we'll see you in the next video.